Please subscribe, like, and share. It really helps us out. And of course, if you have any questions, comment below and we will answer you as soon as we can.
In a significant policy shift, the Bank of Japan has ended its 8-year experiment with negative interest rates, initiating its first rate hike in 17 years. This move adjusts the short-term policy rate from minus 0.1% to a range between 0 and 0.1%. Despite a delicate economic recovery, this change signals a cautious optimism for gradual economic improvement, marking the BOJ's exit from one of the world's most audacious monetary easing strategies. The strategy, introduced in 2016, aimed to stimulate bank lending and invigorate demand by penalizing banks for holding excess reserves at the central bank. With the BOJ's inflation target now within sight, this policy reversal reflects growing confidence in achieving sustained 2% inflation, buoyed by a notable wage increase agreement of 5.28% by Japan's largest employers, the most significant rise since 1991. This policy turnaround comes as Japan, Asia's second largest economy, aspires to overcome prolonged deflationary pressure, in contrast to global central banks hiking rates to combat inflation spurred by the pandemic and geopolitical tensions. Japan's cautious stance aims to rejuvenate its economy without causing undue hardship on households and businesses. The decision's broader implications include potential shifts in global financial markets as Japan's investors may recalibrate their overseas investment strategies in response to changing domestic monetary conditions. Now it's time to think like an economist. Firstly, define the term monetary policy. Secondly, explain how negative interest rates are intended to stimulate economic growth. Thirdly, analyze the potential impact of a transition from negative to positive interest rates on Japan's economy using the aggregate demand-supply model. And finally, discuss whether monetary policy is the most effective tool for stimulating aggregate demand. Firstly, define the term monetary policy. Monetary policy refers to the actions undertaken by a nation's central bank to regulate the economy by controlling the money supply, interest rates, and credit availability. The primary objectives are to achieve macroeconomic stability, including price stability or inflation control, full employment, and sustainable economic growth. Central banks use tools like open market operations, reserve requirements, and interest rate adjustments to influence economic activity. Secondly, explain how negative interest rates are intended to stimulate economic growth. Negative interest rates are a monetary policy tool designed to encourage borrowing and spending by reducing the cost of holding money. Here's how they stimulate economic growth. Firstly, it encourages lending and investment. Banks are penalized for holding excess reserves at the central bank, incentivizing them to lend more to businesses and households. Increased lending supports investment and consumption. Secondly, it promotes spending. With minimal or negative returns on savings, individuals and businesses are encouraged to spend rather than hoard cash, boosting aggregate demand. Thirdly, it weakens the currency. Negative rates can lead to a depreciation of the domestic currency, making exports more competitive globally and supporting export-driven growth. And finally, increased asset prices. Lower borrowing costs tend to inflate asset values like stocks and real estate, leading to a wealth effect that encourages further spending. Thirdly, let's analyse the potential impact of transitioning from negative to positive interest rates on Japan's economy using the aggregate demand-supply model. Using the aggregate demand and aggregate supply model, the transition from negative to positive interest rates can have several impacts. Firstly, the short-term effects. Initially, there will be a decrease in aggregate demand. Higher interest rates increase borrowing costs for consumers and businesses, reducing consumption and investment. A stronger yen, if capital inflow occurs, could reduce export competitiveness, further decreasing aggregate demand. Secondly, let's look at the aggregate supply impact. There will be minimal intermediate effect on aggregate supply as it reflects long-term productivity capacity. However, rising costs from reduced investment could shift the aggregate supply leftward over time. Now let's look at the long-term effects. Firstly, there will be a moderation in inflation. Slower demand growth may curb inflationary pressure, keeping price levels stable. And secondly, structural benefits. Sustainable inflation targets may encourage stable wage growth and long-term investment confidence, potentially shifting our aggregate supply outwards. For a graphical representation of this, the initial impact will be that the aggregate demand curve shifts left due to reduced demand. This leads to lower output and potentially lower inflation. Over time, a successful policy targeting inflation and wages could stabilize aggregate demand, creating a new equilibrium. Lastly, discuss whether monetary policy is the most effective tool for stimulating aggregate demand. Monetary policy is a key tool for stimulating aggregate demand, but its effectiveness depends on economic conditions, particularly in Japan. One of the advantages of monetary policy is its speed and flexibility. Central banks can quickly adjust interest rates or implement quantitative easing, making monetary policy nimble during economic shocks. And market orientation. By influencing leading in investment through financial markets, monetary policy targets private sector spending directly. However, there are limitations. Firstly, liquidity traps. In Japan's case, prolonged low or negative interest rates limited the additional impact of further monetary easing. Secondly, transmission challenges. In an economy with subdued demand or risk-adverse banks, rate cuts may not translate into increased borrowing or spending. Thirdly, a dependency on inflation expectations. The success of monetary policy hinges on anchoring inflation expectations, which Japan struggled with during deflationary periods. So let's compare it to fiscal policy. Firstly, fiscal policy. Direct government spending or tax cuts can stimulate demand more reliably in some contexts, particularly when monetary policy is constrained by low rates. For example, infrastructure investment creates immediate demand for labour and materials. Secondly, monetary policy in coordination. A combination of monetary and fiscal policy often yields better results by ensuring liquidity and direct stimulus. So, in conclusion, while monetary policy is powerful and often preferred for short-term adjustments, fiscal measures can be more effective in addressing demand-side stagnation, especially in economies like Japan that face unique structural challenges. Optimal outcomes typically arise from a coordinated approach between monetary and fiscal policy.
Thank you for watching our video. Please like, subscribe and share. And comment below so we can clarify things for you.